What's up, Outliers? Welcome back to the Outlier podcast. I am joined again with my friend David Hunter. This is, I don't even know how many times we've talked now. It's got to be like half a dozen plus.
At least, yeah.
Yeah, we've had a really fun time exploring the markets and understanding the way that you're looking at things. And as we were literally just talking about before we pressed record here, we are now yet again. I feel like every time I talk to you, we're in these really weird times. It's either a global pandemic or it's some sort of financial crisis, and here we are again. So, welcome back. Looking forward to chatting.
Yeah, hi, Eric. Great to see you. And yeah, never a dull moment here.
Yeah. So, I guess to start off, one of the big things that we had been talking about, obviously, your broad thesis. And before we get into the details of the broad thesis, how it's playing out, and those kinds of things, I was giving you a little bit of context on a general curiosity I have. And again, we approach markets from different perspectives, right? You're a very macro, long-term, big picture view. I'm very trader oriented, day to day, looking to just find what opportunities I can capture. Now, one of the things I find so interesting about markets is that they are constantly evolving, and there can be a lot of periods where you have an idea and then some sort of new piece of information enters the system that wasn't necessarily expected, and then the idea changes. Now, you're kind of experiencing that to, I mean, just a massive effect, not even looking at an individual stock. We're talking a massive global system. And I want to understand the way that you think about how you're formulating these ideas. And for example, the melt up into the bust. That's a really big idea with very specific criteria that you've ironed out and you've shared previously, but it seems so susceptible to new pieces of information entering the system. So how does that play into your broader thesis? Are the underlying conditions so powerful that as new pieces enter the system, they're kind of secondary, the thing's already set, or does it behave differently?
Yeah, surprisingly, I mean, my forecast has not changed a lot. You'll be surprised. It's changed in a more bullish direction, actually. I've raised targets. So surprisingly, as big as the tariffs are, as big as what's going on right now is, um, my underlying macro thesis, the underlying fundamentals and underlying thesis that is getting me to these extreme forecasts, both in the up and the down, are not really changed a lot by what's happening. Part of that is because I'm making some assumptions that the tariff situation will play out and it won't be what we see now. I mean, you saw in the last 2 or 3 weeks the reaction, and your crowd reacts instantly to that and goes to the worst case, right? And then if the tape joins them, they just really go crazy on the downside. Um, I'm stepping back and saying, let the dust settle. This is not what you're going to see over the next several months. He's negotiating. Doesn't mean we won't have tariffs, but they're not going to be these tariffs. And saner heads will prevail, etc. And not that Trump isn't sincere, but because he will keep tariffs if he has to. But ultimately, he's holding most of the cards because we are the big market that everybody depends on, and we take that away from them with the tariffs. Their economies are going to go to hell a lot faster and a lot deeper than ours is. So that kind of helps a lot to not overreact to what is going on. And meanwhile, in the markets and on the street, most people are overreacting, or in my opinion, overreacting, but certainly reacting in a big way. And that only because the other part of me is, yes, I'm long-term macro, but I'm also contrarian, and that just feeds into my stuff. Sentiment's not been this bearish in a long time. I mean, this is as bearish as you get, pretty much. People are just assuming we saw the top, we're going down, and people are playing leapfrog in terms of how low we're going to go. So when I see sentiment at that level, it actually increases my bullishness. And in this case, because of the way it happened, and because of where everybody's positioned, I raised targets.
So that obviously begs the question. The natural question is, if you're thinking about, or if you've raised the targets, which we'll get into, what's the driver behind it? Assuming there obviously needs to be a catalyst to cause that. And we might even come under the guise of, well, even if, let's just use best case scenario where tariffs just go away, that kind of just puts us back to where we were before they went down. That's not like some sort of net massive positive catalyst unless it's combined with a lot of better, agreements that are made.
Well, don't
So
forget, tariffs go away on our side, perhaps. Even the 10% maybe, but 10% or not 10% will be back down from these extra tariffs. The other side is going to have to give up a lot of tariffs. So, I mean, we already have heard that Vietnam's willing to go to zero if we go to zero. There's other trade barriers that cause, there's more to be done. But I think what you're going to see in Mexico and Canada, in the Asian ring, and in Europe is tariffs may not go away, but they're coming down. Those countries, again, Trump is playing poker and he's got most of the cards. He's got the good cards. And I think Besant was the one that said, China's playing with a pair of twos. So, a lot of this is really Trump wouldn't, if he didn't have a strong hand, this would be foolish. But we are the ace in the hole in terms of the markets. These other countries' economies go to hell. Particularly export countries like Germany or like China, and even some of the third world countries like Vietnam. They can't afford to just kind of play hardball and say, yeah, you want to do that, I'll do that. Well, the problem is we can survive much more because we're not really depending on your markets, but you are depending on our market. So I think that's one of the keys. Now, what I would say is that the thing that drove my forecast in the beginning, from the beginning, is I believe rates are coming down. I believe inflation's coming down. I believe the economy's slowing, and that's not bearish, that's bullish. The economy, people, we may be in recession already, but we're certainly heading for a recession. And people think that's a sign that the market's peaked and we sell off. I go, no, the market will go up into that recession as long as it's viewed as a containable recession. If it turns into something much harder landing, then that may end my thesis. But at this point in time, you're not seeing any of that. And I think the odds are that the slow economy will certainly help the bond market in spite of the hysteria last week. You'll see the bond market rates come down. The bond market controls interest rates, not the Fed. So rates will come down, and I think come down quite substantially. I'm still calling for a sub 3% by sometime this summer. That doesn't mean by June, but certainly, by August or September, you could be looking at sub 3%, maybe even 2.5% on the 10-year. That's a huge amount of ease without any Fed. We're having this tit for tat or battle between Powell and Trump. Neither one likes the other one, and it's people get scared of that because they think it's real problematic. I keep repeating, the bond market's in charge of rates. The bond market is the vigilantes, whatever you want to call them, the investment firms that are buying bonds when the economy slows are gonna buy more bonds because the economy is slowing. And I'm not worried about China bailing out on our treasuries. I'm not really worried about Japan. Ultimately, and we saw, we were at 455, 457, several days ago, and we came all the way back down to 4.25 or thereabouts, and now we're up in the 430s. Rates are coming down; they're not going up. So all this hysteria about that just adds to the pessimism out there. And I call that a wall of worry. That means people have acted on their fears, which means they're positioned defensively, whether they're in cash or short treasuries or very defensive stocks. That means the next move will be out of that defensive position, out of that it's buying power for the future. So you'll see them come back into more aggressive positions when the dust clears. At least that's what I believe. So and before the tariffs, was that lower rates, slower economy, lower inflation scenario that was going to drive us to the S&P 7,500. Now I'm saying S&P 8,000.
So I think one of the last times we spoke, I actually think it was around now that you were expecting the bust to be getting close to underway, but it sounds like with the new revision to the upside, things have shifted a bit. What were the primary drivers of the shift as far as you see it?
Yeah, I actually my bust scenario has not timing wise has not really changed. It could get pushed out certainly as this thing if this thing drags out. I came into this year saying probably a fourth quarter event, and I'm still saying it could start in the fourth quarter. Doesn't mean it has to. It could, wait until next year. But I haven't changed a lot of timing because of this, because it depends on how fast this all, works its way through. But the market, in my opinion, that very violent sell-off bottomed, down at 48 or 900 on the S&P, and we've had a pretty good run off of that. There's a lot of people out there expecting a retest or new lows. It's possible. I don't think it's likely. I think we're starting our next leg up. And so, it's not going to be recognized as that for a little while because I think people are still worried about that second leg or second shoe to drop. But you could turn around in a couple of weeks and say, "Hey, we're back near the highs," or we're back, we're back at the high 5,000. Um, so I don't think time wise we might have lost a month.
Got it. Now, what do you make of the relationship with bonds and equities here? Because obviously, for a while, they became highly correlated. Then it seemed like they were starting to resume a normal, less correlated relationship, and then more correlated. The overall behavior between the two has been really interesting. So I'm curious your thoughts on the interplay.
Yeah, it's I mean I continue to expect that bonds and stocks are going to have big rallies into the summer. So it's not just the stock market. I think the bond market, as I said, rates are going to, 10 years going to come down under 3%. That's a big rally from here. Um, I think, slowing economy, lower inflation helps stocks, but it also helps bonds. I just don't buy into this. It was a weird panic. I thought that we all of a sudden we pushed the rate back from sub 420 back up to 450 on the 10 year, and people were panicked. And I said, look, 2 weeks ago, we were at 440, and I had talked about in earlier in March that it was setting up as a head and shoulder top in rates. So on the 10 year, it looked like you had a gap at 440, and you had a right shoulder that, if you did the perfect right shoulder, was at 450, and bonds got up to about 437, 38 and took off and went down under 420. So I said, well, it doesn't have to fill the gap, and it doesn't have to, it doesn't have to be a perfect right shoulder. So maybe we had that correction in rates, and it's now moving down. Well, we got down to almost 4% based on the tariff news and everything. And then it shot right back up to that 440, 450. And everybody's panicking. And I go, it's really, it's 10 basis points above where it was a week and a half ago, or less than a week and a half ago. You guys are acting like the move is from four. It's not. We did a round trip. We just went down and back up. It was kind of a surprise move down to four, and a surprise move back up into this. And then it pushed above that 450 to, that morning to like 457. And people were panicked and saying, China's dumping bonds. This is a sign that there's some kind of a credit event out there. And, people's imaginations ran wild. Well, you let it settle. Even that day, it got back down under 450, and it was down at 427 or something yesterday. So I just think it's much more about people's emotions than it is about reality out there. I think what I see is a bond market that bottomed, several months ago, and it's just working its way higher. Rates obviously topped. Are working with, because people forget we were at 5% on the 10 year, several months ago. So we're still in that downtrend in rates. It just had some volatility within that period.
I see. Now, when Trump first announced the tariffs leading into it, he was pretty straightforward about a lot of what he was talking about doing. And then when he launched the tariffs, the curveball obviously was the 10% on everything. That wasn't really messaged ahead of time very well or at all. And that, the market was like, okay, this is quite a bit different than what I thought. When you're looking at the relationships between the various economies that are out there against the tariffs as they've been set out, what are your thoughts on the game of chicken that's now happening? Because we can see some countries, to your point, definitely Vietnam, a lot of those smaller countries have definitely started saying, okay, we'll play ball. And then there's other countries that are saying, like China, okay, let's play. And there's also the artifact of now Russia and China are even talking about doing natural gas deals together. Obviously, part of that's just being played up to add volatility to everything. But nonetheless, there's absolutely something to be said about other economies getting closer together, ex-US. So how does that all play out in your view?
Yeah, well, first of all, I do think there are maybe 40 or 50 countries that are coming to the table. And I think we are going to see deals announced over the next several weeks. And as those deals get announced, even if they're not the big players, it starts to look like, hey, there's a master plan here that's working. So, obviously the two main players here that are problems are China and Europe, or the ECB, so, or not the ECB, but EU. And I think the EU is starting to come around. They're not certainly not playing hardball to the degree that China is. China was always known to be number one, the primary target, and the biggest issue we have is with obviously China trade, and number two was likely to be the one that would play the hardest ball. They would fight us the most. So all I can say right now is I believe where the market is versus where I think it works out. The market, I think, is far too pessimistic about it. I think saner heads are going to prevail on both sides. It's in both our interests. Again, people, it's almost like investors want to think of this in terms of all or none. Like Trump wants all trade with China knocked off, and we want to bring everything back on shore and all that. It's at the margin. You're trying to get this thing turned around at the margin, and he's right in what he's trying to accomplish. I hear all the time, well, I agree with what he's trying to do, but I don't agree with his tactics. The problem is, if you did it in a more reasonable way, China would never come around. I mean, you've got to do this. And the good thing for our side, I think, is you've got a president who has a backbone, who means what he says, and who will, he's willing to play to an extent, not always, but to an extent, he's willing to play long ball. It's not. Everybody seemed to think he was going to buckle with the stock market, and yeah, he has to. Actually, it was good news to see that he caved a little bit on things and gave
With
90
the
days.
tech stuff?
Yeah, with the tech stuff, but even before that, the 90-day
Yeah, yeah, yeah.
grace period. It's realistic. I think he's got good people around him. People want to portray him as a madman, but Besant's no madman. He's got I think he's maybe the best Treasury Secretary we've had. And although Navarro may be the mad scientist in this design, in terms of what we're doing, he's absolutely right. We've this is 4 decades in the coming, and you just have to do something pretty drastic to turn it around. So, but I think cooler heads will prevail ultimately. I don't know what that will look like. I think it will accomplish some of our goals, but not all of Trump's goals. But I think in the end, what you're going to have, if you fast forward a month, maybe, a month or a month and a half is you're going to have what looks like freer trade around the world, lower tariffs from our trading partners, allowing us to have more access to their markets. Not free access. I don't think we're going there probably. Um, and you're going to be able to look and say, a month ago or a month and a half ago, I thought everything was going to crash. We were going to have, this was the 1930s. This is Smoot-Hawley. We were going to protectionist policies. And now I step back and realize we're freer in trade than we were coming into this year. Um, we're seeing deals left and right of people who are recognizing it makes sense to come and build plants in this country, and both China and the U.S. have agreed to something. I think that lifts all that weight off the shoulders of the market, and it rises aggressively. And then you've got in there short covering that will play, and when you shift from sentiment that's based on dire outlook to sentiment that says, hey, things are may not be um, perfect, but things are looking better than they were coming into this. It's a big move, a big gap between where you were positioned and where you need to be positioned, and that's why markets will get bid up.
Now, one of the things I've seen mentioned about the approach with tariffs so far, which I do find interesting, is there's a really good argument, I think, that the path taken so far definitely, albeit aggressive, does lead to more things happening more quickly. Then there's the other part of this argument that says in doing that, you cause a tremendous amount of disruption, distrust, and other countries might look at it as the US is less reliable. Do you think that there's an element of that at play here? And if so, what impact?
Yeah, for sure. I mean, I would think if I were on the other side of this, I'd be pretty pissed off and feel like, and again, there's that narratives out there around surrounding Trump anyway. So, it's easier to buy into something that's already out there that, he can't be trusted. Um, he'll do these things. But part of that is the element of unpredictability that I think causes them to have to come to the table. If he were predictable, and maybe China thinks he is, maybe that's why they're playing hardball. But I think the longer this stays, they're going to say, "Hey, he's not folding like we thought he would." And if you look at some of the other countries, I think that again, it comes down to their economies. I think we are more resilient given that we are less dependent on exports than Germany, than Europe, than China, than a lot of these countries. And ultimately, I think that's what will get negotiations going. And I think they are going. Obviously, the tougher ones are going to be the harder ones to get to the table.
Right. Well, and it's also been a big part that every time I've seen asked of him how he would treat things like carve outs and stuff like that. And he has made it pretty clear that he's open to discussion. Yep. So I think that tips the hat a little bit in a way from the jump, that he's not necessarily looking at maintaining this longer term, as you've already generally pointed out. Now, the effect of reshoring some of these industries, how does that, in your view, play into the broader economy? Because one of the interesting things I've seen discussed is this conversation around GDP slowing, cutting government spending. Government spending is a big part of GDP. And then you have the conversation of, is that even GDP? And, it's like these different levels to the discussion. But the reshoring element is really interesting to me because, again, I have a military background. And from that, I like that for a lot of reasons. Because as anybody who studies war, it genuinely is won through logistics. If you have really good fighting forces, but they run out of what they need, doesn't matter. They could be really great dudes, really capable, but you can't shoot nothing. So I find from a defensive perspective, it very interesting and pertinent. COVID gave us a little bit of a preamble on what this could look like. But from an economic lens, how does the reshoring element fit into your broader assessment of the economy? What kind of impact does that?
Yeah, first of all, I think you're dead on, and that's where I think Wall Street's kind of short-sighted. Is Trump? If this were purely economic and not national security, then you could say, "Wow, you're making big bets here." And why did we need to do that? Yes, there certainly we would like more industry back here, et cetera, but you're really disrupting a lot to get that. But national security almost demands that we do this. We could, as you well know, we could not do a World War II again. We don't have the steel capacity, we don't have the manufacturing capacity to convert everything over to wartime and roll out the military hardware we need. I mean, it's just not possible. Now, I know electronics is a bigger part of it today, and we could probably do that. But I think national security is a big part of why he's doing this and why he says we can't stretch this out. This has to be done now. Reshoring itself, from an economic standpoint, I mean, you and I know a lot of these commitments are going to take years to build, right? And frankly, you don't know whether you can trust even some of the commitments because some of them will drag their feet and hope he's gone in 3 years, 3.5 years, and never build the plant here. But I think they're going to hold people's companies' feet to the fire a lot. I think to make sure this stuff is, you've started your plant, you're getting going. It's still going to take time, but I think they can move pretty quickly in terms of some of this, and I think he's got plans to kind of incentivize that even. Um, but remember, my forecast is that we're heading into recession, and then that will morph into a global bust. I'm not expecting reshoring to jumpstart this economy and get us out of this, in the next year. I think reshoring will play a big role in the recovery after the bust. It will play a big role, I think, in the melt up in terms of the concept of reshoring and the dollars that are coming in here now, but the actual production that comes out of reshoring and the restoration of our industrial base is really a 2027, 8, 9, 30 type thing. But markets discount ahead. Concepts do help drive markets. So I think the reshoring will help the melt up, but the actual results of reshoring, I don't think we see for a couple more years.
What is the piece of information, the market effect, the occurrence, whatever the actual trigger ultimately ends up being that transitions us right now from this relatively historic pullback, actually, in terms of speed and velocity? This is quite unprecedented. And from a trading perspective, it's fascinating because a big thing that I trade is volatility, and you can track how volatility has changed over the past decades, which is a whole other thing. But going back to the actual trigger event that leads to moving from where we are now into the melt up, what is that?
Yeah. So first of all, that sell off. I mean, if I were a technician, and I've seen plenty of technicians that are in this position, I'd be bearish, right? I mean, we broke pretty significant trend lines, and there's all kinds of reasons why you can look down. And yet I didn't falter a bit because again, just like 2020 was kind of never saw that before, 35% down in 3 weeks, and yet I turned really bullish then. This same thing here is the sentiment was negative going into it and turned so negative that I said these breaks are, I don't want to call them false breakdowns, but they really were very quick and very temporary. And so that's why I was not surprised to see the rebound that we've seen. And I think it's a real rebound, not a relief rally. So that, first of all, it'd be easy to be bearish, but from a technical standpoint, so I understand why it has caused so many people to jump on that bandwagon. However, you know, I guess maybe it's my 50 years of doing this or whatever. These technical rules are broken all the time. If you get caught in a dogmatic view of how charts work, and if you get this break, it means this. You're gonna get burnt, because for every rule, there's going to be an exception, particularly in a period like this. And you have to step back and look and say, why did we get this break? What is that break doing? It's really causing people. It was almost um, a way to manufacture fear. That all you had to do was break that 5,500 on the S&P, and you knew that there was another big step down coming, and you got it the next day or the next couple trading days. Um, Same thing. Obviously the Russell looks terrible from a technical standpoint, and yet I'm pretty bullish on it. So I think there are times when you have to learn that yes, technical analysis is an important tool, but don't make it your Bible. Don't think it that sometimes it can be a fake out. So on the other side, in terms of the bullishness, I think, as we always find, it starts moving up like we're seeing now, just from, it feels like relief rally, and because people start moving away from their worst fears, and then as tape moves up, more people jump on. I think, are you chasing a fly or what?
No, I'm looking at the charts here because it's really interesting. I'm watching the difference between the E-minis, NASDAQ, and Russell. I actually had a follow-up question for you, but I didn't want to interrupt you.
Yeah, that's okay. So I think we're moving into that period where if it keeps going here, that momentum works in reverse. All of a sudden, the tape moving up is going to first cause some short covering, which we've already seen some of that. But there's a lot more that can happen. And then as the tape continues, it just drags people back into the bullish side. No matter what, momentum, um, you know, causes sentiment. People really react to the tape, and they've reacted very negatively to a negative tape. I think it won't be that long before you start seeing that turn around. And people have to remember, you start from the lower left, move to the upper right, on sentiment too. So you start at the bottom with, deep bearish sentiment. That's a bullish thing when sentiment's this deeply bearish, and it doesn't move straight to bullish. It kind of moves less bearish, more neutral, and then bullish, and then extreme bull. So I think you'll see that play out over the next 3 to 6 months.
Now, when I'm looking at the major indices here, I mean, from like a 3-month perspective, all of them are still pretty firmly down sloping. There was that fair recovery on the 9th of April, but then it's kind of been stalling and starting to fall past that. So are you viewing this just bouncing back and forth that we're kind of doing now, since it's not like plummeting back down, but it's also not shooting up here? Do you view this more as like a consolidation thing? And then if so, what then becomes the catalyst to lead to the melt up?
Yeah, I mean, I'm not a trader, so I don't pretend to know what the next week's going to look like, and so if I were betting, I would slightly bet that we're probably up from here. That you get a day or two of this, make it look like it's rolling back over, but it doesn't last. But if it did roll back over and retested, that wouldn't change my ultimate opinion either. So I'm not caught too much in the very short term. My guess is, I'll let the tape tell us, but if this thing reverses back up here in the next, either tomorrow or the early next week, this was just kind of a couple day. What you're also getting is not just obviously technicals. What you're getting is news events. The minute something comes out on Trump says something else, out come the sellers again saying, "Oh, see, we're not out of the woods." So you're going to have volatility based on whatever he tweets or says.
Standard.
Yeah, yeah, definitely.
One of the things you mentioned earlier was referencing the 2020 bear market and then the eventual rally out of there. I think obviously the thing that comes to people's minds with that is, had the Fed not intervened and did kind of historic measures, there's a
Yep.
good chance that could have led to a pretty big problem.
Yeah, I was bullish. I was bullish in March of 2020 because of the Fed's response. You know, it was
Right.
$5 trillion. Not we didn't know 5 trillion initially, but there was a lot of money coming in, along with a lot of programs from Congress. So that was what gave me the confidence then. I don't think we're going to see that here by any means. I think we're in a different place for different reasons. I'm bullish, but yeah, you're lacking anything close to that right now. There's no urgency on the part of the Fed. You know, if anything, the Fed's still talking a long game of, we want to see what happens with the tariffs before we come in. I don't, I really ignore Fed commentary in between meetings. They're doing two things. They're trying to send a message, and Waller came out and talked more like ease isn't far away, and the next day Powell's pretty much putting him back in his place with,
Yeah.
we're not anywhere near thinking that. So I think they want to convey a message that they're not in a hurry to ease. That I think they're wrong in terms of feeling like they're in a kind of a great spot where they can pivot either way depending on what they get. To me, they're not really, as is typical of the Fed, they're not really getting the leads and lags. They give lip service to leads and lags and understanding there's leads and lags to policy, but the way they act, they're caught looking at backward-looking data and extrapolating forward until proven otherwise. And with leads and lags that are 6, 9, 12, 18 months long, depending on what you're leading to, you can't play this backward-looking. We're data dependent, and that's what they're doing. I think it's pretty easy to look at what the tariffs are doing to companies and to worldwide trade and say there's going to be disruption in the economy. Not initially, because initially you're getting numbers that are probably people buying ahead of the tariffs, right? So you're getting some, like, you got good retail sales, and you're seeing some things that say the economy looks pretty good. You can't go by those numbers because those are basically pulling from the future. I think once we get out a month or two, numbers could not crater, but be down quite a bit. I think, I very definitely think we could be in recession if we're not already, before this quarter is out. So, for the Fed to kind of sit on their hands and say, "Oh, we're in a good place. We don't, it's the economy's okay, jobs are okay. We could just kind of take our time and I think if you delay here, you're going to have to play catch up, and that catch up will help my meltdown."
Now, one of the things I'm so curious about here is the relationship of the recession, because typically at the onset of a recession, markets do generally react negatively to that. And before, you had mentioned that you'd view the recession actually as a potential bullish catalyst. So then I'm trying to understand the timeline as you're seeing it, with the involvement of the current state, the melt up, and a recession potentially in like the next quarter. What does that timeline actually look like? Not, again, specific dates, not specific months, but just
Sure.
the relationships.
Yeah. So probably standard way people would look at things is that the market leads economies, right? So that the market would typically top out 6 months ahead of the economy, maybe, and start discounting this, the recession, or 6 to 9 months ahead of that. We're nowhere near. I mean, if we're in recession this quarter, obviously the market, just topped out in March. I'm looking at it as and this is not kind of what we see typically in our cycles, but we're not in a normal cycle. I'm looking at, there could be a period here where, and I think there will be a period here where it looks like soft landing or slow down, mild recession. And the Fed's responding to it, saying, okay, now we got to ease. We're seeing that. But we're not in a hard landing scenario. In other words, the narrative will still be soft landing, soft landing accompanied by lower inflation, and maybe a lot lower inflation. Keep in mind um, the narrative out there just weeks ago, and I think for some people still, is that inflation's ticking up, not down, right? Everybody's worried, even the Fed, worried about inflation going up. I think inflation's going down. True inflation, the measure their measure is 1.3%, I think. They're below the 2% target. Housing is rolling over because of these high mortgage rates. And You've got oil down at $55. I mean, I don't know who's looking at higher inflation here, I think. And again, the one thing that's pushing everybody to higher inflation is saying tariffs are inflationary. Tariffs aren't inflationary. They cause a one-time bump in prices, but they also cause a big dip in demand. So, it's not sustainable inflation if that's the story. So I think the Fed's got it wrong. Those who are worrying about inflation have it wrong. And they're within very short time, I think they're going to come around to, wow, inflation's actually moving towards that 2% target pretty fast. So you'll have lower inflation, soft landing, even though it may be a mild recession. And finally, the Fed at our back, the Fed back cutting rates and maybe even pumping a little money. And that happening at the same time that the tariffs are starting to get normalized, the tariff policy is starting to get normalized, and people say, "Oh, it's not what we were fearing." You get all that in a concentrated period of 2 or 3 months, and you can have a rip roaring market.
I see. Yeah, I can follow the thought process there. What are your thoughts around you were saying tariffs may or may not be inflationary depending on the effective demand, but what do you think about elasticity's involvement in that? Because with how broad the tariffs are, there absolutely are going to be components that are captured that will have different measures of elasticity and the ability to either experience a decrease in demand or just accept heightened cost.
Yeah, it's hard. I guess I've kind of put it on the sideline a bit and said, until we get clarity on what really is going to come, because I still think the
I see.
primary story is negotiation and if anything, moving towards freer trade, not more protectionist trade. You have to do this to get there, but I'm just kind of at this point saying, let's not jump to the negative side when the probabilities really suggest, at least for me, that more likely we're going to see negotiations and things. I, Trump may be very sincere about liking tariffs as a revenue raiser, but I truly think his primary use of tariffs is to bring the other, our trading partners to the table and say, enough's enough. We've handed you our markets for free for too long. You have two choices. You can either, run into real resistance. We can do what you did to us, or we can both agree that you have to lower your tariffs so that we have more access. That I think is the more likely outcome of this. Not everywhere, maybe, but I mean, I look at Canada. Canada and Mexico are kind of a different story in some ways, but when you look at it, it's like there's no way that we're gonna be where we are right now in terms of hurting each other. It doesn't make sense. There's got to be a true negotiation in both those countries where they come around to some extent and understand we're not taking everything away from you, but we can't have it the way it is, where you're you're tariffing us to the point where we don't have much in your markets, and yet you have access to our market. So, and he's trying to accomplish some other things there too. So, I just think, I guess I have some faith in Trump as a negotiator.
Well, and I think another data point that supports pieces of that is I don't know if you saw this thing with the Texas and Mexico, like this water deal. Are you familiar with that?
No.
I never heard of it before either, but and I don't want to speak too incorrectly about it, just at a high level. I recently was reading about it, but there's an agreement where, as we were dividing like the Rio Grande and whatnot, that there's a certain amount of water that is owed to us by Mexico to Texas, that we historically haven't collected on. And I think it's coming up this year. It's like every decade or every 5-year time frame, a certain volume is due. And we've never bothered with it really. Um, and Trump is now saying he wants to collect on that water for Texas. So I think not, aside from the actual details of that, I think it does highlight part of what you're talking about more broadly. Whereas there's this global negotiation going on where we're trying to actually reestablish footing on a lot of different things. And yeah, that very much seems to be at least part of what's at play here.
And I think, I don't think we can make light of the fact that whether you call it TDS or just a dislike or distrust of Trump or what have you, it pervades Wall Street. It pervades, obviously, Washington.
Well, he's polarizing.
It pervades the media. Well, wait, no, I'm saying the opposite. I'm saying the perception of him, because people believe that he's polarizing or believe or just don't like him or his style. He's a very much New York style, in your face.
Yeah.
And his whole negotiation style is, I play hardball and then we back off from there. It's the art of the deal. I start with my most extreme negotiating position, and then we work forward from there. But all that, plus everything else that surrounds the politics from 2016 on, and particularly the left's view of him, but certainly a lot of Wall Street bought into that, and a lot of population bought into it. That's all part of why I think that everybody sides with, we really have a strong reason to be doing what we're doing. We've given away our country for 40 years in a lot of ways. It benefited Wall Street, but it didn't benefit middle America. And that's truly what he's trying to accomplish, is bring back the jobs for middle America. That should be something that people are, getting behind and very much supportive of. But because of TDS or whatever you want to call it, there's this natural tendency to doubt that he's doing anything good, that he knows what he's doing. I think he will go down in history as maybe a more successful president than Reagan, and accomplishing bigger things than Reagan. But he's going to have to prove that, because so many people doubt him. But I think that's why people, instead of this country kind of getting behind what we're doing, they always assume that we have the weak hand and that the other side's going to play us or whatever. We are in the driver's seat in a lot of ways because of our markets, and Trump understands that. I mean, we are the market to the world, and so there are problems. I'm not saying that it's easy street here, but I'm just saying I think the perception on Wall Street is because a lot of Wall Street is just like Washington. They don't like him, or they don't trust him, or they have TDS, whatever. And he's got some good support and good people that back him, and I certainly do. But I do think if you were to take a poll, a lot of what's the rhetoric out there, what's the sense out there, it's coming from personality more than it, and dislike of that personality more than it is reality. So that's contributes to the bearishness, contributes to the doubts, and I think the picture is probably a lot better than that.
Well, it's one of those things that's so fascinating because it's multivariate, right? There's a lot of different angles you can take, because the concept of him trying to bring back the middle class or reestablish it in some of these different ways, totally can see that view. And then there's also the view of, well, if you're a person that's looking to retire in the next 6 months, you're terrified right now because of this damage that has been done that directly affects you, unfortunately, because it is the middle class and the lower classes that don't have, obviously, the excess disposable income to be able to survive those kind of drops and be able to, live off of the same style. So it's one of those things where it's just such a fascinating culmination of, to your exact point, personality, timing, issue prescience, depending on what matters to the individual. Because no matter what, as you've kind of pointed out here, there's no easy way to refoot America without causing massive disruption. It's just if
Yeah,
you're going to try to.
and frankly, I think it's naive to say we can go along the way we've gone because Wall Street's still doing okay,
Right.
and most people have equity in their homes and stuff. Meanwhile, we're handing advantages left and right to China that we won't be able to make up ground. We're really at that. It's kind of the same thing as last November in the election. It truly was, um, I think, a do or die election. If it had stayed, I don't want to get too much into politics, but if it had stayed with the Democrat candidate, it was very much moving us closer and closer to globalism, closer and closer. The globalist agenda is really a weak U.S. agenda. Looking for and we would be at some point we were heading towards the British Empire, the Roman Empire, and this is our last best chance to reverse 40 years of bad policy. It's not all Democrats, the Republicans. With the exception of Reagan, the Bushes were part of that globalist agenda too. Um, and this was really a one-time chance, and it's a short window. I mean, we don't even know if he's going to have a window beyond the first 2 years because of election,
Right.
your election, midterm elections. So he doesn't have a lot of time, and he's trying to accomplish a lot of things. It's not just deregulation is another big story we haven't talked about that will be an offset to some of the negatives of tariffs. Deregs is a big deal in terms of, so you have to kind of look at his whole agenda and realize
Also taxes.
it's taxes, and whether he gets to everything he wants, probably not. He is a pro growth president, and we should be excited about that. And unfortunately, it is that negativity towards him. And frankly, Wall Street's kind of betting their book too because they'd much rather have things as they were. They were fat and happy, and Main Street was getting hit pretty hard. They're still kind of wanting to stay fat and happy and not worry about Main Street. Well, thank God we have a guy in there. It's a populist president. He's sincere about that. He really understands middle America's been hit hard for decades, and it's time to bring that back. But for two reasons: economically for them, but also national security reasons.
Another broad question I had with respect to just the economy and the inputs to it. My wife and I, we like to travel a lot. We actually just got back from Ireland, and we notice when we're in a lot of these other countries, when you go into convenience stores, when you go into gas stations, when you go into shopping centers, you notice that it's like mostly local people that are just working those, lower level jobs, those base level jobs. And a lot of places in the US still do that, but then there's also a lot of places that don't for a litany of different reasons, living wages and stuff like that. The question I have with respect to the economy and employment is what effect does that have that like the base middle class, quote unquote, which is also this esoteric term that ranges widely what people consider middle class. But what effect does that have when the living wage and the lifestyle that those kind of people would want to be able to work for seem to not either be available, not desirable? Both of those, I think, exist to a pretty big degree to the individual. What effect does that have on the economy? And then I'm curious about the reshoring effect here. Like how many Americans are going to be actually really excited to go to these kinds of jobs potentially?
Yeah, it's probably gonna have to evolve. As always, it's not gonna be instant. We're giving up college. We're going to work in a factory or whatever. I think
Right.
it'll evolve, and the jobs are going to be very different. Robotics is going to play a role, et cetera. So, I think technology is going to be a big part of the new job landscape too. But I'll answer it a little different way, which is um, part of his deregulation is banking. I have argued for a long time because I started in banking in in Indiana where it was countywide branching. You couldn't have a statewide bank. Your largest the farthest you could go was your county lines. So we were the largest. The bank I started with was in my college town. It got me into the investment business. It was a two-man shop. I was the second guy. So, but it was great training, and we had a lot of because it was Northwest Indiana. We had a lot of Chicago and Indianapolis bankers in the back, that wanted to be out away from the city and had expertise, but were, so I was exposed to pretty good people, um, but then we had, over the course of the next 30 years, deregulation of banking and, went from that to statewide and then to, nationwide banking. So you had the Bank of Americas and the Chases and the Citibanks, et cetera, that became nationwide, big banks and some of the big super regionals. What we lost, though, in the process is a lot of the banking is branches of these big banks in the smaller cities and towns. You lost that president of a local bank that had, was in the Rotary Club and was, friends with all the businesses in town, and a lot of the what they used to call the three C's, which included character, credit, character. I forget what the third one was, but basically, when they were making loans to their neighbors, and now it's once we went to this full on big bank um, model, everything was a formula. You had people taking your credit application, but they didn't care who you were. They just said, "Oh, you don't meet our criteria," or we're not lending that much right now, so you're not going to get it. I think our smaller cities lost their heart and soul as a result of that. So going back that way, I think will be a big part of it. The other thing I'd say in relation to, so you're right, I do think you go to these other countries and you see locals, they're working in their towns and they're basically it's like we used to be. Um, the other thing I will say is that without government spending, without the huge blow up in our government, the huge growth of our government over the last 30 years, everybody would realize our standard of living's been dropping. But it was held together because of lots of handouts, lots of entitlements, lots of things. And unfortunately, in the meantime, we're not recognizing that we lost a huge part of our true productive economy. And what we're doing here, Trump has said it, is we're trying to replace a piece of government spending with private. We're starting to, reshape the pie so that there's more private, more efficient private enterprise um, economy and less government. But it's a Queen Mary that's got to turn around. But I mean that we've been asleep at the switch, and certainly our presidents for the last many years have been asleep at the switch. Reagan did some things in terms of bringing down the onerous tax rates. He did I was there then, and it was viewed as an impossibility to, we had whatever they were, 80% marginal tax rates, maybe it was even 90. And he brought them down to, into the 30s, and ultimately, I think the 20s. Um, that was viewed as impossible, and he got both sides together and got that done. He obviously, brought down the Soviet Union with what he did, in terms of military spending and standing up to them. So, but beyond, other than that, I mean, for the last, most of the last 4 decades, it's been, this huge government largesse and handouts. And meanwhile, we look like we're the strongest country out there, but there's a lot of hollowness within. And I think this is our last great hope to kind of reverse that. And I do think, in kind of direct answer to you, I do think you will see the new generation of workers coming up being more willing to forego college and say, I can make a good living, in whatever industries, whether it be auto manufacturing or other things. And that's the other thing Trump is doing is he's trying to. We used to kind of give lip service to this need to reshore. But he understood, or his people understood, if you look at the auto industry, we're assemblers. Yes, we're making cars
Right.
in the country, but we're bringing the high tech part of that car in from other countries. He's looking to reestablish our engineering expertise, and the higher end value of the car, the engines, and all of that. I think all of that is something that nobody else even thought about, and it's a good thing we are.
Yeah, well, and it's a really big problem to solve. It's really interesting. And before you had mentioned a little bit about like what commodities might look like, specifically a little bit about steel and aluminum. But in this new direction, let's call it, that things are going, what's your broader view on commodities? Because you also mentioned oil being positioned where it is, which has been actually really interesting to me. Um, Talk to me about your lens with respect to commodities.
Yeah. So as you know, my whole big picture view is that we would have, this last blow off in this cycle's economy, where we would have commodities participate in that, have a run up in copper to $6, and um, probably see lots of commodities move up. But then the global bust would hit, mostly centered in next year, but maybe starting this year. And it could take copper all the way down to $1 even, certainly $2, and could then likewise with aluminum and steel and et cetera. So that our starting point going into the next cycle is going to be much lower commodity prices. And I think that's not in most people's forecast. I mean, I think because not very many are looking for a bust. Um, so I do believe the response to the bust will be this massive fiscal and monetary response to the tune, as I've said, of 20 trillion coming out of the Fed, and likewise something similar coming out of the government to try to bail out a free falling worldwide financial system. I think, and again, all the central banks doing the same thing. So I think you get out a couple of years from the bust, and you're looking at rapidly rising commodity prices along with rapidly rising inflation. And it means you could see copper, which let's say it gets to 6 this cycle, maybe next cycle it gets to 25. Oil is 60 now. I think it goes to 30 in the bust. At the beginning of the next decade, I think it could be $500. So you're going to have huge run up in commodity prices, but not straight from here. So you have a couple years here before people realize that the reshoring and everything we're doing is ultimately going to. Well, the reason you get the run up in the commodities is because you can have, as you industrialize America again, as we move more to an industrialized economy away from consumer, because the consumer is going to be flat on his back after the bust. As you move into more industry driving the economy, that's more commodity intensive. And if you're building factories, you're building plants, you are obviously demanding steel and aluminum and every other commodity, and we won't have the capacity to satisfy. If you pump up the economy to the tune of 20 trillion here and maybe 60 trillion worldwide, whatever it is, um, unheard of. I mean, we did 5 trillion was unheard of in 2020. Before that we had done 3.7 trillion over the decade before that for the Great Recession, in response to the Great Recession. Before that, the balance sheet of the Fed was 875 billion. And from 1913 to 2008, it had only grown to 875 billion. Now we're talking about it maybe growing to 30 trillion in a matter of years. Um, that is going to that money goes into the pie and blows up demand. And in this case, blows up industrial demand because you're trying to reshore. And you can't build capacity for commodities that fast. So you're going to have demand blow up very quickly, meaning in a matter of a few years. Capacity to satisfy that demand takes maybe 8 or 10 years. So you're going to have a period for several years where demand is far outstripping your capacity to satisfy that demand. The only thing that gives then is price. So that's why you can get oil going from 30 to 500 or copper going from, $2 to $25. And I'm just throwing numbers
Sure.
out there, obviously, but I think it's going to be unlike anything we've ever seen.
One last question before I let you run. Obviously, the interest there is it would seem that before oil ever got to 500, that there would be either some sort of intervention or some sort of broad change in energy usage, meaning pivoting more to other fuel styles. Now, as I think about your idea, what would prevent that is if it happened so fast that none of that could occur quickly enough in order to move. But I'm curious if that's even remotely close to accurate or what your view is there.
You'll have lots of substitutions. For example, we're obviously jumping our restarting our coal industry.
Right.
I think you're going to see that play a big role in trying to satisfy some of that because we're just not going to have the oil to satisfy the demand or the natural gas, which is kind of, everybody looks at it, trades in a $1 to $3 or $4 range or whatever. That could go to $50. I mean, you're just not going to have. You're going to have peak oil be a topic again. You're going to have for years we haven't really done a lot of deep water drilling, right?
Right.
Because of the we were trying to certainly for several years we've been trying to trying to de-emphasize fossil fuel energy and also oil was kind of in a area where they said we don't need to spend the extra money it takes to do deep water. We're getting it in shale oil, or we're getting it here or there. There's going to come a time we're going to need every resource out there, and that's when end price will justify the drilling, etc. And so, yeah, sure. As you move up, you're going to see more electric cars. That's what I've said forever. Is it's not that we won't see electric cars. We just shouldn't have had the government decide when we should do it. Let the markets determine when it's economically viable. Don't subsidize. You won't need to subsidize because there's going to come a time when there's a crossover where you say, "Hey, I'd rather have an electric vehicle," even
The
though electricity is going to be expensive too. But you know, there is a point where the market will solve all these things. The problem is the government always thinks they're smarter than everybody else, and they want to engineer when things happen. They want to be in charge of when things happen instead of letting the markets determine that.
the funny thing about that is obviously I live in California and the electric car thing really big deal here, right? Because a lot of people are doing their best to try to be environmentally conscious, but then every once in a while you'll get notices, that don't charge your car, or don't run your air conditioning if you're charging your car because the constraints from electricity. So I chuckle because of exactly what you're talking about there. Um, Last thing I want to wrap up with is when you look out as things sit right now into 2025, what are the top two or three things that you're keeping an eye on that you think, as those things move, indicate progression or a shift in your overall thesis?
Yeah, certainly the tariff policy. We'll want to see that I'm right, that we will at some point in the next month or two see a lot more movement towards negotiation. Um, if China continues to play hardball and we just continue to ratchet up tariffs, then you can crack things, and it can be a lot. You certainly have to factor that in. So tariffs are one, or the whole process of negotiation is one, and the other one I think is kind of the is going to really, I think, impact exactly when the Fed comes in. Not that I need the Fed initially. I mean, as I've said, rates are going to come down without the Fed. So people will think that, I think we could get a cut in May, even though Powell doesn't know it yet. He's talking the other way, but I think we could get a cut in May. Whether we do or not doesn't really matter to my thesis, but um, but I think watching jobs and whether that, we start seeing that slow down more, watching just the overall economic data, because that's where I think, you know, I am very confident that Powell is not watching the stock market. He's not worried about trying to prop up the market. But I think there is a crossover point where if the economy weakens, he can't sit on his hands any longer and say, "Hey, we're waiting on tariffs." He's going to have to come in. So I'd be watching just general economic data and certainly jobs because that's what they're focused on. But jobs is a laggard. That's why the Fed drives me nuts because they should know better than to use a lagging indicator as their sign of when to move on something that has a long lead time. It's just backwards thinking.
When I look at the next couple weeks, the tariff that you mentioned, the broader tariff policies seem to be just at an absolute highlight as a massive determiner of where things go from here. Now, the final thing I'm curious about, we've talked about this from the lens of expecting tariffs to be used as um, negotiation tools. What's your view if that is not the case for whatever reason? Let's just say that they end up staying or it just becomes more aggressive. What's your view of how things might progress if that ends up being the scenario instead?
Yeah, then it comes down to how fast do things deteriorate? Because I think it is hitting the economy. How fast things deteriorate versus how fast does Powell um, recognize that he's got to abandon the worry about inflation and focus on the economy? Because I think that's coming. It's just a matter of is it coming in May? Is it coming in June? Um, anybody that thinks there's a Powell put or a Fed put on the market, no. He's made it very clear he's not going to blow up things again, pump up the money again to support the market. But I think that entire FOMC board, their whole mandate is, you've got to make sure you don't tank the market. You're our support. So as much as he and Trump may be not liking each other, I think he still is sincere in knowing what his job is, meaning Powell is sincere in that. And I think he's got a pretty good, solid group of economists there. Austin Goolsbee, I think, is a smart guy that has enough tendency to understand that I've got to, we can't wait and sit on our hands until we see, the whites of the eyes of recession. We've got to act sooner. He's at least one that gets that, and I think will be one of the ones pushing in that direction. He's held off to date, and I think I keep saying, if you judge the Fed on the basis of the last year, you'd have to give them high marks because they brought inflation down without causing a recession. The
Mm-hmm.
big question now is going forward. I'm not worried that I've been very defensive of Powell, been defending him against a lot of critics based on what we've done last year. But let's criticize him. Basically, he was more right than anybody in waiting. And what they did last year was, took some pressure off and wasn't the wrong thing either. But their rhetoric right now gives you the indication or gives you the impression that they are going to wait a long time before they ease again, or that they are not in any hurry to ease. And I think we're very close to a time where he should be doing it pretty aggressively. So whether that's May or June, I think if he thinks it's 6 months off, I think he's going to get bad grades going forward. Good grades up till now, but the Fed always has a history of staying the party too long on the tight side and creating a hard landing when it could have been a soft landing. And that's my fear again.
Yeah, bond rates right now are showing 90% probability of no change in May, and then a 71.8% probability of 25 bips in June.
Yeah,
So,
yeah. As I say, they're a group, they're a committee that has made plenty of mistakes over the years. Not just this committee, but the Fed in general,
right.
FOMC in general. I don't try to predict meeting to meeting what they're going to do. I do say what I think they should do, which is I think
Sure.
they should cut in May. Whether they will or not, I think again, if the economy's where it is today, they probably won't. If the economy softens from here and inflation continues to head lower, as I think it is, I think they may reach a consensus to say, yeah, we could do probably won't be a half, but they could do a quarter, and then if it continues to deteriorate, do it again in June. That's what people don't realize is neither, and you're a trader, so you get this. Neither the traders um, bet, whatever it shows, 90%, no cut. Neither that nor what Powell says today means a thing because it can change tomorrow. If you get some data that changes the trader's view, you're going to see that number change a lot. If you see data that changes Powell's view or gets Powell's attention, he'll change between now and May 7th. So, I get people putting those numbers up to me every day and saying, well, what do you're saying they could cut in May, and this is telling you you're wrong. And I'm going, I could care less what their point of view is at any point in time. It's between now and May could be a long time if things change.
It's funny you mentioned that because if you look at the bond market's pricing of federal fund rates, I always remind people when they say, well, it said 90% probability of this and then this happened. I always tell them, look at the historic prices. You'll see how schizophrenic they are. So
Yep.
it shows just exactly what you're highlighting. It's actually really,
It's a point in time expectation. That's all it is.
yeah,
And
yeah.
Powell's a human being. Yes, he has access to a lot of data, but he's shown that, as the Fed always has been, they're data dependent, and that data is really backward looking. So, you get some data that changes his mind, he'll change his mind.
Yeah, makes sense. So you've given us an overview of what's happened since the last time we spoke. You've given us what you're thinking things look like going forward over the next year or so. Is there anything else that you'd like to hit on before we wrap up?
Yeah, just because we had a good kind of 100 miles above the surface talk today, and that was good. Just to kind of bring it back to the numbers,
Yeah, please.
as I indicated before, I raised my S&P target for this is my pre-bust or melt-up target. The target at the top this year to 8,000 from 7,500. I did that right smack in the middle of the sell-off. When we were down below 5,000 on the S&P, when everybody else is lowering numbers, I raised them. My Nasdaq target had been 25,000. I raised that to 27,000. And I am very positive on semis. Semis being obviously everybody's turned pretty negative on them, and they've been hit hard. I have a 400 target on SMH, which I think it was down 190 or thereabouts. So more than the double from here. And people think I'm crazy, but I think once this thing gets going, you're going to see semis lead the pack again. I also raised my target on the three things I raised my target on were the Nasdaq, S&P, and gold. And I've raised my target from 3,400 to 4,000.
No change in silver?
Silver, because I had a 75 target, it's still quite a ways away. So, down the road, if it proves itself, I might. But right now, I've just kind of left that one. Whereas gold's got the momentum, and I think really 4,000 is very doable for this year. So that's a pretty big adjustment for gold.
Definitely. Yeah. That's why I thought it was interesting, because I think it gives a little insight into your perception of the relationship between gold and silver because of the adjustment in gold and silver.
Yeah, gold,
where
I'm
it
just
is
recognizing the momentum. If you look at it, if we run from the low 30s to 75, that's more than certainly well more than a double, 120% or whatever.
Yeah.
Whereas the move from 3,300 to 4,000, is whatever that is, 20 some odd percent. So I do expect silver to very much outpace gold from here. Now, silver gets a bad rep because everybody thinks it's not done anything. from the lows of a couple of years ago, from 2022 lows, gold and silver until very recently when gold had this last spurt had traded up, had pretty much doubled, almost doubled each from that low. So the perception you have is that silver stood still while gold's had a nice run, right? Well, it's part of that is because silver is more volatile and typically does outperform, and it hasn't outperformed yet. It's basically been performing almost in line, but with a lot more volatility. I think from here you should see silver really start to be the leader. But gold will still have obviously a nice run up to 4,000.
That leads to one more question. Sorry. But the recent drop in silver, I thought that was very curious compared to what gold's done over the last couple of weeks. What did you make of that move specifically?
Unfortunately, I think silver is obviously more economic, and so it's probably somewhat a statement. I mean, copper dropped from $5 down to $4 or whatever. I think the economically sensitive metals got hit harder, and I think there were some fears that they were going to tariff it. They didn't end up tariffing silver, I don't think, but it's just the more volatile metal, and as people risk off, they sold those things that they were most nervous about. And that really, when you talk about that sell off in the market, and you could easily, and I saw many a technician get very negative, and many strategists get very negative because of the breaking of so many key levels. But when you really step back and realize that a lot of it was forced liquidation, margin calls, and such, and the rest of it was basically just plain panic, risk off. I'm getting out because I'm not sure what's happening. This is a crazy policy. We've never seen this before, and because everybody did it in a concentrated way, yeah, you broke some. I think you're going to break them on the upside just as quickly. So, but that's what I kept saying that whole week that we were, just getting hammered. I just said you got to let the dust settle. I think this is just panic.
I see. Yeah, I follow you there. Well, as always, really, really interesting talking to you, getting caught up on
Eric, I lost you.
Oh, sorry. I still got you. Can you see me?
Yeah, no sound.
I think we are back online. But I was just saying, as always, it's really interesting understanding your lens of like what's happened, what you're expecting to see. So thank you for taking the time to walk us through that. Now, people can still reach out to you on X. I'll make sure to throw your correct link in the notes below for them to check out. They can, I assume, still DM you for your quarterly newsletter. Is that still accessible to them?
Anybody wants details on the letter, just DM me.
Beautiful. And then anything else that you'd like to direct people towards?
No, I just think we're in for a heck of a next, between now and the end of the summer. I think you're not going to have a relaxing summer on the beach, is the way I'd put it. It could be fun, but I think it's going to have people in our business are going to want to stay next to their desks, next to their computers, I think. So.
Yeah, well, I fully agree with you there. It's been very eventful so far, so fully expect it to continue. But thanks again for coming to hang out. And as always, I'm sure we'll connect again in a few months and we'll see how things trend.
Yeah, thanks. Great conversation, I think. Thank you.
Beautiful. See ya.